Welcome to our guide on essential market terms that people use very often. Whether you are new to investing or looking to deepen your understanding, knowing these market terms can be a game changer. Indicators like market indexes, bull and bear markets, and liquidity help you see the bigger picture and make smarter investment choices. They provide insights into market trends, risks, and potential opportunities, helping you better navigate the ups and downs of the market. Today, we are going to break down some of the most important terms in simple ways so you can confidently interpret the market and understand what they mean for your investments. Let's dive in and unlock the power of these financial terms. An index is a measurement that represents a section of the stock market. Think of it as a gauge for the market's overall performance. Popular indexes like the Nifty and the Sensex track a specific group of companies and give you a snapshot of how that segment of the market is doing. For example, the Nifty 50 includes 50 large companies from various industries in the National Stock Exchange, giving a broad view of the stock market. When the index goes up, it generally indicates that the market or specific sectors are performing well and vice versa. For investors, understanding indexes is crucial for evaluating market trends and the performance of their portfolios relative to the market. A bull market is a period in which prices in the market are generally rising. In a bull market, there is typically a sense of optimism as investors expect growth and are confident in the economy. This can lead to more people buying stocks, pushing prices even higher. Bull markets can last for months or even years and often occur when economic indicators such as employment and GDP growth are strong. Recognizing a bull market is useful for investors because it often signals a good time to invest, although it is still essential to evaluate individual stocks carefully. Bull markets reflect positive investor sentiment and are usually associated with economic growth and strong returns. A bear market, on the other hand, is when prices in the market are generally falling, often by 20% or more. It is a period of pessimism, where investors may be losing confidence and selling pressure drives prices lower. Bear markets can be triggered by economic downturns, rising unemployment, or global events that disrupt market stability. Although bear markets are challenging, they also offer opportunities for long-term investors to buy quality stocks at lower prices. For beginners, understanding bear markets is key to recognizing when prices are likely to be volatile and the importance of staying calm and sticking to your investment strategy during these times. Volatility measures the degree of variation in a security's trading price over time. High volatility means prices are moving up and down quickly, while low volatility suggests more stable prices. Volatility is often seen as a risk indicator. The more volatile an asset, the greater the risk, but also the potential reward. It's like a heartbeat for the market, giving you an idea of the level of uncertainty or excitement among investors. For beginners, understanding volatility can help you gauge whether an investment is too risky or suitable for your comfort level, especially if you are planning to hold it over the short term. Liquidity refers to how easily an asset can be converted into cash without affecting its price. High liquidity means you can buy or sell an asset quickly, while low liquidity indicates it may be harder to find a buyer or seller at the current price. For example, cash is highly liquid, while real estate typically has low liquidity because it takes time to sell. Liquidity is important because it impacts how flexible your investment is. High liquidity assets can be sold quickly if you need funds. Knowing an asset's liquidity helps investors manage risk, especially in times of market stress or sudden financial needs. Market capitalization, or market cap, is the total value of a company's outstanding shares. It is calculated by multiplying the current share price by the number of outstanding shares. Market cap is often used to categorize companies. Large cap companies are typically stable and well established, while small cap companies might offer higher growth potential but come with more risk. Understanding market cap helps investors choose stocks based on their risk tolerance and investment goals. Large cap stocks are usually less volatile, making them suitable for conservative investors, while small cap stocks might appeal to those seeking higher returns. Yield is the income return on an investment, usually expressed as a percentage. For stocks, yield refers to the dividend income as a percentage of the stock price. While for bonds, it is the interest income relative to the bond's price. Yield helps investors compare the income generated by different investments. A higher yield often indicates higher income potential, but may also signal higher risk. For beginners, understanding yield is essential for assessing whether an investment aligns with your income expectations and risk tolerance. Knowing how to interpret yield can be valuable when planning for long-term income. Volume is the number of shares or contracts traded for an asset during a specific period. High trading volume suggests strong investor interest and can indicate that the price trend is backed by momentum. Low volume, on the other hand, might indicate weak interest, which could lead to price fluctuations. Volume is an important tool for assessing market activity. High volume often coincides with significant price movements, whether up or down. For beginners, understanding volume can provide insights into the level of demand for a stock, helping you make better informed decisions. The price-to-earnings ratio compares a company's current share price to its per-share earnings. It is a popular metric for evaluating whether a stock is overvalued or undervalued compared to its earnings. A high price-to-earnings ratio might suggest that investors expect higher growth in the future, while a low price-to-earnings could indicate that the stock is undervalued. For investors, the price-to-earnings ratio is a useful tool to assess whether a stock is priced fairly in relation to its earnings. It is one of many factors to consider when making investment choices, especially for beginners who want a quick snapshot of a stock's valuation.